When you hear a lie long enough or you hear something repeated long enough, you actually take it as gospel. And I'm no different. I hear things over and over, and I start thinking that may be true. And one of the areas that this shows up in quite a lot is, these beliefs or these ideas around growing money or making money in the stock market. And there's this one idea, this one belief that is beaten down on us since, I believe, birth, to the point where people actually start believing it. And I want to take this idea, this belief, head on today for this weekend podcast and show you with evidence how, in fact, the people who have been talking about this one idea, this one belief, in fact, have actually never really looked to see if it's true. Hey everybody, this is RC Peck, and this is my weekend podcast, my Fearless Wealth weekend podcast. And my theme of the week, or my theme of the weekend, is the stock market is incredibly inefficient. And I can prove it to you. And I don't want to prove it to you for proving it to you's sake, but I want to show you how this is actually what I think most people are looking for. This is the system. This is the approach. It's easy. It's straightforward. It's consistent. It has continued to work for the last century, actually century and 15 years. And if you look at the market as something that is incredibly inefficient and that has a lot of mood swings and is manic and depressive, you start to notice that, in fact, there's not much that is efficient about it. And the more manipulation and intervention and high-frequency trading and hedge funds and fill in the blank we get in this world, the more inefficient it becomes. So I want to prove this to you in three price charts that, if does not prove to you, you should greatly increase your questioning of, is the market really inefficient? Or is the market really efficient? I think the market is incredibly inefficient. So the first price chart I want to show you is a price chart of Apple. And if you look at the screen, this price chart of Apple is about a 3-year price chart of Apple. And at the very top price point, Apple stock is about $700 a share. And then from mid-2012 to, let's just call it mid-2013, all in all, it falls about 44%. 44%. Now, is Apple causing cancer of the brain? Is it killing people? I mean, what justifies one of the best run companies in the world, one of the best brands in the world? People love this product so much that they line up outside all the retail stores around the world to be one of the first people to get one of their new launch or new version products. But it fell 44%. This should never happen in an efficient world. In an efficient world, maybe something falls 10 or 15%. But Apple fell 44%. It lost, get this, it lost $250 billion of its market cap in 7 months. $250 billion of its market cap. Now, at the same time, it was sitting on $150 billion of cash. I mean, this is incredible. This should never happen. All those conventional advisors, whether they're big box or independent, would say, oh, the news was bad, blah, blah, blah. But that's garbage. News always follows price. And you know that if you've listened to me for any amount of time. So here's an example of an incredible, inefficient event that happened. Now, this is not a one-time event. Maybe it is for Apple. But this is happening dozens and dozens and dozens of times a year. Also notice, Apple, this is not a $500 million startup or a one-year-old startup. This is a company that's been around decades and has a mass following. Let me show you another example. After I show you that big down red arrow, here's another example. Here's this company called McDonald's. You've probably heard of this company. Been around since the 50s. It lost 17% of its market cap or $17 billion. In this case, it was about a $100 billion company. When it fell 17%, it lost $17 billion. Well, what happened? Were the events that happened between January 2012 and November 2012 really worth losing $17 billion of market cap in McDonald's? There's a gazillion McDonald's all over the planet. This is a well-known brand. Everybody knows what the golden arches look like. In fact, when I used to live in Hong Kong, one thing I love, there's many things I love about Hong Kong, but in Hong Kong, you can buy Egg McMuffins 24 hours a day, which I love. This should never happen in an efficient market. You should never see a $100 billion, well-established, 75-year-old company, worldwide, global brand, fall like this. Then you say, oh, well, maybe the stock market fell. No, it didn't. In fact, the stock market was going up at the same time period. Same thing for Apple. When Apple fell 44%, the stock market was going up. So you can't blame the stock market. This should never happen. This is incredibly inefficient, but it happened. The market is inefficient. The market is there for you to exploit. This is how you make your future secure. This is how you make your future free, by implementing a strategy that takes advantage, that leverages this inefficiency that happens all the time. I'm going to give you one more example. Not that two, there's dozens, but I'm going to give you three. So here's my last example. Here's this company that you may have heard of. It's called Intel. It basically makes all the stuff that you don't even know you need with the internet and electronics. Well, guess what? In 7 months, this company lost $50 billion in market cap, or a third of its market cap. Was it going out of business? Was it going the way of Enron? Was it causing car crashes? Was it killing people? No, none of that was happening. There is an incredible level of inefficiency in the market because of high-frequency trading and manipulation and intervention and just normal human beings' emotions. If the market was efficient, you would never see Apple or McDonald's or Intel lose tens or in some cases hundreds of billions of dollars of market cap while the stock market is going up. I want you to really challenge this idea that you can't beat the stock market. Of course you can. Get out of that conventional thinking or get away from those conventional advisors, whether they're big box or independent, and start looking at the evidence. This is how you secure your future. This is amazing. This is a well-established company that is not going anywhere. All three of these companies pay great dividends. This is the inefficiency of the market that is just begging you to really to step up and leverage it. And again, just notice, these companies are huge. They're global brands. They're some of the largest, best-run companies on the planet. These sell-offs or corrections or inefficient moves should never happen. But in fact, things like this with the top global brands in the world, the biggest 100, 200, 300 companies in the world, you get 2, 3 dozens of these sell-offs every year. And this is where the money is to be made. This is where you get your money back. Now, the question should be asked, well, what happened after those inefficient fall-offs, corrections? It's a good question. So Apple, after that 44% fall, increased its price 56%. Pretty amazing. Apple pays a 3% dividend. McDonald's went up in price 23%. Intel went up in price 36%. What is safer than buying something after it's fallen 20, 30, 40%, and it's a global brand, and the market itself is going up? You have extreme safety there. This is what I want to impress upon you, how you can actually get back your future. And the point I really want to hit home and have you notice this weekend, or when you listen to this, is really take advantage of how inefficient the market really is. And you don't have to act risky. Notice, we weren't in a stock that was $100 million, even $1 billion market cap. It wasn't a stock that was around for a year or 2 years. These are companies that are around decades. and our global brands. This is how you secure your future. This is how you make sure you never run out of money. You make sure you have enough money. This is the exact way you do it. It is straightforward, it is clean, it is clear, and this is what my clients get when they work with me one-on-one. And you get this too when you see the positions I buy. And this is one of the reasons why one of my strategies, which I call obvious trend, has done so well over the last 4.5 years, which is when January 1st, 2010 was the first time I started making those returns public. So look, this is just another step in helping you really take back control of your future, take back control of your money, so you can finally get the future and the present moment that you deserve. You guys have a great week, and I'll speak to you soon.